Hi everyone, welcome back to Corporate Decoder, the place where we break down the boring stuff and find the real meat of company reports. And today we're diving deep into Ares Real Estate Income Trust Inc. And let me tell you, their latest report has some interesting shifts that might surprise you. We're going to uncover what their numbers really mean for the company and for investors who might be watching. So stick around as we decode this financial puzzle. We also have a growing Discord community where we discuss these kinds of insights. So make sure to join us there. The link is in the description below. Alright, so what we have here is a look at Ares Real Estate Income Trust Inc. as of July 31st, 2025. Think of this as a snapshot of their financial health and what's going on under the hood with their property investments. The main story here is an update on their net asset value, or NIV, which is basically what they believe their company is worth per share. They're giving us the details on their assets and their overall portfolio performance. Now, companies like this have to file these reports regularly to keep everyone informed. This particular filing is just giving us an update on their net asset value, or NAV for short. It's like checking the price tag on their entire collection of real estate assets. The big headline is their net asset value per share. This number tells you the value of each share based on the company's assets minus its liabilities. It's a key metric for investors to gauge how the company is performing. They've got a whole process for figuring out this number, and they even have an independent company called Altus Group helping them out. This is good because it means an outside expert is looking at their property values to make sure everything is on the up and up. They update this net asset value every month. Now let's get into the juicy part, the numbers themselves. This table shows us how their total assets are broken down and how they changed from the end of June to the end of July 2025. It's a great way to see where their money is invested and how those investments are performing. Looking at the residential properties, they have a significant stake here, with $2.63 billion in July compared to $2.5 billion in June. That's a solid increase, showing growth in their housing investments. However, we see a notable dip in their office property investments, dropping from $460 million in June to $383 million in July. This could signal a shift in strategy, or maybe some properties are being sold off. It's definitely something to keep an eye on in this sector. Overall, their total investment in real estate properties saw an uptick, going from $6.1 billion to $621 billion. That's a healthy increase in their property holdings. On the debt side, they have line of credit term loans and mortgage notes, which increased from about $249 billion to $258 billion. This means they've taken on more debt to fund their operations and investments, which is typical but always worth watching. And the bottom line, their aggregate fund Dave ended July at $2.61 billion, up from $259 billion June. This shows a positive overall movement in their net worth. This next table breaks down the net asset value per share for different classes of their stock. It helps us see the value on a per share basis for each type of investor share. Interestingly, across all the different classes of shares, and even for the OP units, which are like units in their operating partnership, the NAV per share stayed exactly the same at 770,835 for both July and June. That's quite consistent, but it also means that the overall increase in the aggregate NAV was spread evenly across all shares. They are also telling us here that they set aside money for future distribution fees. As of July 31st, 2025, they estimated about $64.8 million for these fees. They don't include this in the NIV calculation because it's about future payments. Now, this is a really important point. They are not applying any discounts to their net asset value for the fact that their shares are not easily traded on a stock market like regular company stocks. Their redemption program has limitations and can even be suspended. If you wanted to sell your shares, this illiquidity means you might not get the exact NIV price, and they're being upfront here saying the NAV isn't a promise that you'll get that exact amount if you sell, or if the company were to sell everything. It's a valuation, not a guaranteed sale price. This next table gives us a peek into how they value their properties. They use things like exit capitalization rates and discount rates, which are basically ways to estimate future cash flows from their properties and figure out their current worth. For example, their exit capitalization rates, which is the rate investors expect to earn when a property is sold, vary by property type. For residential properties, it's 5.1%, and for office properties, it's 7.33%. A lower cap rate generally suggests a higher property value. The discount rates they use, which is how much they want to earn on their investments, also vary. For industrial properties, it's 7.4%, and for office properties, it's 8.9%. Higher discount rates mean investors demand a bigger return. They've also included a sensitivity analysis here. For instance, if the exit capitalization rate decreased by 0.25% across the board, that would increase the value of their residential properties by 3.3%. If it increased by 0.25%, the value would decrease by 3.0%. This shows how sensitive their property valuations are to these key economic inputs. They also talk about distributions here. They authorize monthly gross distributions of $0.0345 per share for July 2025. This is a slight increase from their previous distribution of $0.033333 per share. This means they are distributing a little more cash to shareholders, which is generally a positive sign. Let's look at their actual holdings. As of July 31st, 2025, they owned 129 real estate properties covering about 25.3 million square feet across 34 different locations in the US. Importantly, these properties were 94.6% leased, which is a strong occupancy rate. Their leverage ratio was 35.8%. This ratio essentially tells us how much debt they have compared to the value of their assets. A ratio below 50% is often considered healthy, but it really depends on the industry and the company's ability to manage that debt. In the first part of the third quarter, up to July 31st, 2025, they raised about $91.1 million. This includes money from investors reinvesting their distributions and from selling what they call DST interests, which are tied to specific properties. On the other hand, they had $14.5 million in requests for investors wanting to redeem their shares or OP units. This means some investors were taking their money out. These redemptions were handled on August 1st. Now, you'll always see a section like this where they talk about forward-looking statements. Basically, they are saying that some of the things they talk about are predictions about the future, and these predictions might not actually happen. They list a ton of risks and uncertainties like inflation changes and interest rates, geopolitical events, and general economic conditions. They're essentially covering themselves by saying things could go differently than planned. And finally, they list the exhibits that come with this report. One of them is a consent from Altus Group, those independent valuers we talked about earlier, which lends credibility to their own reported valuations. Now let's put it all together. Ares Real Estate Income Trust Inc. appears to be managing its portfolio actively, with growth in residential properties but a decrease in office holdings, suggesting a strategic pivot or perhaps a reaction to market conditions in the office sector. The consistent F per share across all classes is notable, indicating a stable valuation approach, but the lack of discounts for illiquidity in their share redemption program means investors should be aware that selling might not fetch the exact NAV. The company is raising capital while a significant amount of redemption requests are also being processed, which is a common balancing act in non-traded REITs. The detailed sensitivity analysis on their property valuations highlights how changes in market rates can impact their reported net asset value, a key factor for investors to monitor. Overall, they seem to be navigating the real estate market with a strategy that includes growth and careful valuation, but the illiquid nature of their shares and the potential impact of economic shifts remain significant considerations for any investor. Alright, that's our breakdown of Ares Real Estate Income Trust Inc.'s latest filing. What's your take on these numbers and what they signal for the company's future? Do you think their strategy is sound, or are there red flags you're seeing? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate finances. Don't forget we have a Discord community linked in the description where we discuss these kinds of insights. So join us there. Thanks for watching. See you next time.